Welcome to Stocks in Translation. I'm Jared Blikre, your host, alongside Sydnee Fried, who you know as the People's Voice. Some brief housekeeping notes. Be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Amazon, Apple Music, iHeart, or YouTube. And today we are welcoming in Raoul Pal, who is the CEO and co-founder of Real Vision. He's also a 20-year veteran of the global macro investing and a very early adopter of Bitcoin and crypto. Hello, guys. And today we're going to be talking about the Roaring 20s. We're in them. Where do AI and crypto, where do they take us by the end of the decade? And our word of the day, that is compounding. Warren Buffett loves it because what is here today is double that tomorrow, the magic of exponential math. And this episode is brought to you by the number 3, as in 3%. That's how much the U.S. dollar has appreciated since the election, which is a lot in currency land. So what a strong dollar means for global liquidity. Raoul, just thank you for joining us here by the day.
Great to be here, in person finally.
Yes, finally. What do you think of the market since the election?
It's kind of as I imagined. I mean, obviously, there's the enthusiasm over what Trump's policies might bring for markets, particularly technology. It's very bullish for technology, very bullish crypto. And then we've seen what do the tariffs mean for the dollar? And the dollar's been ripping higher because of it. Rates are unsure how to deal with all of this. So the market's still trying to figure out all of this stuff. But generally, the playbook seems to be that the technologists have taken over the White House, and therefore they get a free run.
Should people be reacting to an election like they are? Is that normal?
It's not abnormal, and sometimes this whole thing fades because really it's about what policies actually happen, what happens to the economy, what happens to things like liquidity. So we may wish it to be so, but the reality is we need to see what actually plays out.
All right, we're going to take that thought and we're going to amplify it. We might compound it because that is the word of the day, compounding. Compounding is a process where growth builds on previous growth, accelerating exponentially over time, whether it's money, knowledge, or resources, creating increasingly larger results. And the trick is, Raoul, you deal a lot with this, and we deal a lot with this in finance. Humans are wired for linear thought, but when it comes to the exponential, it's a different game. Just talk to us about that.
Yeah. Exponentiality is something most people can't comprehend because we think of the passages of time. That's our real anchor, right? And time is linear for us. But exponentials are things that grow on top of each other. You're talking about compounding, particularly when it gets to crazy things in technology or crypto or adoption of technologies like the internet or AI. What happens is the numbers go really fast. So the greatest living example of all of this is probably outside of viruses and biological things where exponentiality occurs often is Bitcoin. Right? Bitcoin came out, 12 years ago, essentially started trading. It's up 105 million %. You can't get your head around it. And if you divide it by
Zimbabwe numbers.
I know. But that's the power of compounding. It's an asset that essentially goes up on average 150% a year, even with 3 negative 80% drawdowns. And so you can't get your head around those returns. I mean, I was an investor in 2013. No way that I think it was going to do this. I mean, I knew it was going up a lot, but these kind of numbers are ludicrous. So you only need a small amount of money, which is one of the reasons why a lot of the CEOs and founders of the big technology companies are worth so much money because they never sold their equity. So time horizon plus high rates of growth compound into ridiculous profits.
But it seems like to kind of take advantage of that, you had to be in something like Bitcoin a long time ago. Or do you think even 10 years from now, if I invested today, you still think there's going to be crazy returns 10 years from now?
So Bitcoin is just part of blockchain, which is technology. And the adoption of that technology has been twice the speed of the internet, based around the same time, first 5 million users. So it's extremely fast. Right now, it's a $3 trillion space in total. But if you extrapolate out the trend rate of adoption, looking how the internet did it, et cetera, by about 2032, 2034, we get to something like 4 billion users, maybe more, and that would extrapolate to a $100 trillion asset class, in line with other major asset classes. Okay, so that's $3 trillion to $100 trillion. So we're only 3% of the way there. If this plays out, that will be the largest, fastest accumulation of wealth in all human history. Now, assume I'm a complete idiot and I'm wrong by 50%. it would be 50 trillion, which is the entire 100-year accumulation of value the S&P 500's had. So that's what we're dealing with. So no, it still compounds.
So are you hodling here? Because it's from the outline of your strategy, you really need to stay in the market to take advantage of these gains. And you mentioned the founders, and their secret is they don't sell.
That's right.
So you're sitting on all this wealth. How do you use it? How do you capitalize on it? What do you do with it? Do you stake it? That's something that kind of came up. But what do you do with this to take advantage of it as you're holding or hodling?
Well, to set your life up for this, you have to have an income. Because if you're not going to take money out of the market, because it compounds so much, every penny you take out, the expected future return is diminished.
That's the nature of the question.
Right. To put it in perspective, the NASDAQ divided by Bitcoin, essentially, the NASDAQ has fallen 99.99% in 12 years versus Bitcoin. So it essentially means that each year you don't buy something like a house, the cheaper it gets in Bitcoin terms. So really you want income to deal with that. If not, you can't. And then you've got three strategies. One is just hold it and do nothing. That works over time, but it's very cyclical. The other one is try and time the cycles and try and lower your exposure at the top of the cycle, buy at the bottom.
We've seen that movie.
Yeah, that's pretty hard to do. The other one is what I've tended to try and do is accept the cycles and say, well, if the price is weak and it's down 80%, buy more. And what happens is you compound even faster.
So you're dollar cost averaging.
If I am only in ETFs that track the major averages, do you consider those returns over the course of someone's life compounding? Let's see, I don't know, the S&P goes
if you
up
stay in
10, 20% every year-ish with some down years. Like, is that considered compounding?
If you stay in, right?
Yeah, if you stay in, it does. It compounds over time. The problem is people's expenses, particularly the fixed things in life like houses, those become less affordable over time, and a share of the S&P doesn't buy you any more of them. So you're not really compounding and getting ahead. The reason we invest is future deferred consumption. It's like it's for our future selves. Now, if you end up saving all this money in the S&P 500 and it still doesn't buy a house in the future, well, then what's the point? And this is something to do with the debasement of currency that's been happening from liquidity and printing of money. Now, when you actually look at all of these things together, the global governments have been basically increasing liquidity, debasing their currencies by 8% a year. And there's about 3% inflation rate. So 11% a year. Property hasn't beaten that. S&P hasn't beaten that. Gold hasn't beaten that. Almost nothing has, except two markets in the entire world. One is the NASDAQ technology, because it's in a secular trend, and the other's crypto. So you want to be careful what you compound, because if not, you're still not getting ahead.
Can we go back to that 11% and break that down into its components again?
So the global central banks plus governments roughly increase global liquidity, that's the amount of currency in the system, in dollar terms by about 8% a year. In years like COVID years, it was a lot more. They withdrew, for example, in 2022, but on average, it's been 8%. And so what that's meant is basically if you divide the stock market or real estate by that 8%, it's kind of flattish. The difference is, on top, is inflation.
And you're adding that on top, which I find interesting.
That's right, because one, debasement of currency affects scarce supply assets, stocks, gold, real estate, stuff like that, crypto. Inflation is your variable costs, food, stuff like that. I mean, I cannot believe it. I went for dinner on my own.
Oh, right.
On my own here in New York. I had 2 glasses of wine, a steak, a salad. It was $160, and it was not a fancy place.
Sounds
I'm
about
doing
right.
that math
That is
in my head.
inflation.
Yeah. So going back here, so should you just pour all your money into tech and crypto if these are the things that are compounding the most?
I know it's not fashionable because if people think about diversified portfolios and diversify your risk.
Buy bonds.
Right. Yet you're just not getting ahead, which is why all of the millennial can't buy a house. They can't get ahead. They're doing 3 jobs, right? It's the same issue, is it doesn't do enough. So in the end, I've had to throw out the rule book. I was a macro guy. I traded diversified portfolios my whole life. I'm now ultra concentrated because these are the only two assets that make the difference.
That's a really interesting point that I want to just kind of focus on for a minute. Global macro is just this huge field, and I've been learning about it over the last couple of years from an online gentleman I met online, Macro Alf. But you came from a school of thought that's all about diversification for the most part, and now you're very concentrated. Just kind of take us on that journey.
Well, macro is about trading the business cycle and looking how the economies move markets. You try and predict economies to try and forecast markets. That's really the macro game. And the big gains used to come when everything blew up because everything moves very fast and a big amount. So most macro guys tend to be very bearish. They're looking for the blow up trade. Something changed in 2008-12 where suddenly the blow-ups didn't really last. Even the pandemic lasted, 1 quarter?
Right.
And this was driven by this new use of liquidity in markets. So I had gone from looking at like having some stocks in India and maybe some credit and then some bonds and some FX trades to realizing that there was these two mega trades driven by this, what I call the exponential age, that it made everything else not worth doing. The NASDAQ alone does 17% a year, including the bear markets. So that already beats that hurdle rate of 11%. And Bitcoin's done 150% a year, including 3 down 80%. So what it does as a macro guy, I'm like, well, I can either continue to do the same thing I'm doing, or I can lean into these two secular trends, because they're all about adoption of technologies, and do that instead. So I've gone from being diversified, broad in my approach, to ultra concentrated, which at first is uncomfortable to do.
I would think so.
But then you find it's a lot easier because you're really focused on the one thing that matters. And as long as you understand the drivers, it's pretty straightforward.
Hold that thought. We need to take a short break, but coming up, we're going to be talking the mighty greenback coming on strong after the election. But what is the potential fallout? And on today's Who Wore It Better, we look at who's set to dominate the AI race. All right, we are back. This episode is brought to you by the number 3 for 3%, which is how much the dollar has appreciated versus the euro, the pound, and also the yen since the election or thereabouts. And that's a lot for currencies, 3%, which tend to be highly leveraged. U.S. presidents tend to talk a good game about wanting a strong dollar, but when it's too strong or when it quickly rises, that can spell problems for risk markets. So can you talk to us about the dynamics of the dollar and global liquidity here?
Yeah, so when the dollar is too strong, we talk about the dollar wrecking ball.
Yes.
Because what happens is, in a world that borrows a lot of dollars, the dollar that's expensive means it's difficult to get enough dollars in the system to pay off global debt. So we've seen, for example, China's real estate sector. It's mainly a dollar borrower. When the dollar's expensive and they earn in yuan, it's difficult to pay the debts. So that tends to what happens when the dollar is high. And what it does is withdraw liquidity from the markets because so much of your extra expenses are in servicing of those dollars. So when the dollar liquidity comes, it can start to slow the economy and particularly markets, but it is forward-looking. So the recent strength in the dollar and the strength in rates probably leads to some sort of market correction towards the end of the year, beginning of next year, because the liquidity has been drawn out. It actually takes a while to filter through. So a strong dollar, as you say, is good if you want to be the reserve currency, but it's bad if you want economic growth everywhere. Because if the Chinese can't grow because the dollar's too strong, or the Indians can't grow because the dollar's too strong, well, then they don't demand your own goods and the world economy slows down. So you really don't want a strong dollar.
Two things. First, what actually defines a strong dollar or too strong? Is there a level?
It's not so much level as rate of change.
Okay.
It's the rate of change. You can adjust to most things over time. But if it happens fast, as Jared said, it's happened really quickly. So people were not expecting that. So suddenly there's a demand for them to somehow get those dollars, and it's going to cost them more of their local currency. So they'll demand less of other goods, stuff like that. So it slows everything down.
And crude oil, we see it measured, it's priced in dollars. How does that affect investors?
Normally, a strong dollar is strong crude prices, but we've actually got an inverse relationship right now because of the Trump factor, because he's come in and said, pump, baby, pump, or whatever he says. And that's
Drill, baby, drill.
drill, baby, drill.
To quote.
And basically, what that means is there's going to be an excess supply of oil because the US is the world's largest producer of oil. So that's kind of decoupled these markets somewhat. But oil prices falling is a positive for liquidity because it means people have more money in their pocket or manufacturers have more margin and stuff like that. So these conflicting signals right now that are kind of offsetting each other, but we need to see how this plays out. My guess is the dollar peaks out somewhat around here. I think the appointment of the Treasury Secretary is going to make a difference, depending who it is. I think one person will be a stronger dollar candidate than another. So we have to kind of wait and see for that one as well.
You mentioned transmission mechanism, or at least alluded to it. The dollar feeds into liquidity, which then feeds into markets. I'm wondering what you're seeing in terms of timing right now. So we just had the U.S. dollar index. It's not the best index, but it's well known, just hitting multi-year highs, but it's kind of a resistance level that it's hit many times before. Like, where do you see the Dixie or just the U.S. dollar basket going in the next few months?
Normally at this point in the business cycle, it should be weakening. Normally when the economy is just starting to pick up now.
Powell's, he's lowering rates, right?
That's right. He's lowering rates, slower than the market wants. I get that. The ISM survey, so the business cycle, is still below 50, so it's not expanding. Normally when it starts expanding, the dollar weakens. And that's been a historical pattern that happens. Right now, it's not gone above 50 yet. That's one of the signals that should change the dollar. All the forward-looking indicators suggest the business cycle is going to pick up. So the dollar should weaken from here, unless something really weird is happening. The other side of the equation is rates. So US rates, particularly—
Yeah, we didn't even get there yet.
Yeah, is the 10-year rates, etc., have been backing up. Why is that? Well, it's not inflation expectations because they haven't really risen. What it is this massive issuance of debt that has to happen to roll over the $10 trillion of debts that we have to roll in the next 12 months. And so the market can't absorb it right now. So without the Fed cutting rates and injecting a lot of liquidity, which they're not in the US right now, there's not enough demand for the bonds, but the Treasury needs to issue them, and it's making the market freak out a bit, which is pushing up the dollar. So we're kind of trapped in this no man's land right now. We need to see liquidity coming because liquidity is too tight, both in the US and in Europe. But they're still so scared about the inflation scare that they had. Don't forget,
Europe is very scared of inflation. Yeah,
they are, and pretty much every government's been lost because of it. I mean, literally every government has gone to the other side, regardless if they were left or right to start with. They got blamed for the inflation, out the door. And so, I think we'll see the same in Canada soon. We'll see the same. We've seen it everywhere.
It's time now for Who Wore It Better. Today, we're going to be diving into the race to dominate AI. Will it be the startups or the tech giants like NVIDIA and the hyperscalers? On one side, you've got the scrappy AI startups, lean, innovative, and laser focused. They're driving breakthroughs with speed and agility, often compounding small discoveries into substantial developments and advancements. And on the other side, we've got the tech behemoths, the companies like Google, Microsoft, Amazon, pouring billions into research and development, plus NVIDIA itself, making the picks and shovels, as they say. So, Raoul, who is building the AI flywheel better? Is it the startups or the giants leveraging their power? Who's going to win this race?
So far, it's been very difficult for the startups to make progress unless they're doing something radically different. So we're hearing of people using different substrates for compute, like biological compute. Okay, it seems that the big companies aren't doing that. Anybody else needs access to compute. And unless you've got Jensen Huang on speed dial, you ain't going to win that game. So you need to have a super breakthrough in a model. So you might see some applications layer stuff, as they call them, wrappers. And we'll definitely see some gains there. I think it's very, very difficult to beat. The one that, if we look at the big companies in this space, the one that's wildly undervalued, that's nowhere near its high yet, is Tesla. Tesla, in record time, put up this gigantic kind of compute center. They have obviously all of the compute from the cars for these video models that they're building, and obviously XAI. There's a lot going on there, and obviously to train the Optimus robots. And so that's probably still the undervalued one, and a much purer form of the AI bet than, let's say, Google, which Google's so diversified and they failed to execute well
so far.
And Microsoft is, but again, you're lost in this huge, massive company where you're only getting part the returns of AI.
People are lost in the monetization game, it seems, expecting all these profits up front, but it seems like a lot of that just comes down the road necessarily. How do you square all of this with the coming, or if you even think it's going to be coming, AGI, artificial general intelligence, which, if you believe in these trend lines and the compounding effect, might be here by 2027?
Yeah, I agree. I think it's coming faster than people expect. I think people are still wildly underestimating what is happening. And they might overestimate. In fact, no, I've not seen anybody overestimate the speed of this so far. I mean, every 3 months, OpenAI or whoever nukes everybody by completely changing the game.
I know, my workload gets easier every few months.
I know, it's incredible, right? You just start speaking to your ChatGPT. You can now put in charts.
My late nights have never been better.
I do love ChatGPT.
It's incredible, right? And especially with the voice mode. But there's some of these models, Anthropic stuff. These things are amazing. They're moving so fast. But people are wildly underestimating the changes that this technology is going to bring to our working lives, to our lives as humans, to medicine, to the economy, to so many aspects. People can't see it because we're not good with exponentials, and this is basically an exponential squared. It's
an exponential of an exponential.
That's right. Well, that's Reed's law is Metcalfe's law squared, and that's what we're seeing here. This is easily the fastest adoption of any technology the world's ever seen. Blockchain was held that mantle for a while, but this is so much faster. So Moore's law, which is the improvement in compute
from the 1970s, yes,
every 2 years it doubles. Well, this appears to be going at every 6 months it doubles, 4 times the speed of Moore's law.
So you're adding zeros every few years, which
when we talk about compounding, this is why none of us know. And when people say, well, what does it look like in 10 years' time? Literally, none of us are used to dealing with this scale of growth. Don't forget the intelligence of these models. If we look at the last GPT model, has an IQ of 120. Okay, so that's smarter than the average human. In every single subject known to humanity. It is a polymath that's smarter than most. And intelligence is doubling every year. So by next year, this thing is 240 IQ, which is smarter than any human. And then 480, then 1,000.
How should you think about investing in AI? Like, should you go in for specific stocks? Should you just go ETFs? Your average person?
I think, as I said, stuff like Tesla, I think, is still undervalued. I think all of these stocks will do fine, but they won't make your fortune in the speed, the speed of growth of this stuff. You won't make as much money in the equity.
I hear you. And we need to leave it there. Really appreciate you stopping by in person, Raoul Pal. And we are winding things down here, so be sure to check out all our other episodes of Stocks in Translation on our mobile site and on Yahoo Finance, our desktop site. We're on all your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. That's all for now. Keep your dial tuned to Yahoo Finance.